Welcome back, ladies and gentlemen. Let's now continue with chapter 2. So far we've talked about source documents, and now I want us to move to books of original entry, and then we'll move to journals, then cash book. So let me just take you to this other template where we are doing the explanation. So here we are saying that books of original, rather, a book of original entry is refers to accounting book or journal where all transactions are initially recorded. It refers to an accounting book or journal where all transactions are recorded. Remember when we started, we said accounting is a process, and the process starts from source document to journal then to ledger. Then from ledger we move to trial balance, and then from trial balance is now when we do our financial statements. So here we are seeing a book of original entry refers to an accounting book or a journal where all transactions are initially recorded. So in short, we are saying that the second step of accounting process where we are doing the journal is where we are, or rather it's the book of original entry. So here we are saying a journal is a book of original entry. So again, we are saying this book can also be called a first entry or preliminary entry. It is the journal in which invoices, vouchers, cash transactions, others are first recorded before they are transferred to ledger accounts. So when you start, rather, the accounting process starts with the source documents. It goes to journal, goes to ledger accounts. Then the journal is where we record the transactions of the source documents. And this journal is what we are calling the book of original entry. Then again, we are saying this is to say that before any details of business transaction can be posted into accounts in proper ledger, they must first be recorded in the book of original entry. So here it is very simple. The book of original entry is the journal. So we start from source documents. So the transactions in the source documents, we record them in the journal. And then from the journals is when we move to ledger accounts. So the journals are what we are calling the books of original entry. So we have quite a number of such books of original entry. We have sales day book or sales journal. We have purchases day book or purchases journal. And then we also have the cash book. So the books of original entry, we also call them prime entry books, or we call them subsidiary books. And the major subsidiary books or the major books of original entry, the sales day book or the sales journal, and the purchase day book or the purchases journal or the cash day book. So ladies and gentlemen, I hope you understood what is meant by the books of original entry. And now let's move on to journal. And then here we are saying journal, rather, we are saying a journal is a detailed account that records all financial transactions of a business to be used in future reconciling of accounts and the transfer of information to other official accounting records or ledger accounts. So these are the official accounting records, are just the ledger accounts. So the journal is what we are calling previously the book of original entry, or the prime book, or the subsidiary book. Is where we first record the transactions from the source documents before we move to ledger accounts. So journal is a detailed account that records all financial transactions of a business to be used for future reconciling of accounts and the transfer of information the official accounting records. So down here is a sample of a journal, where a journal must have a date. It must have the details of the transaction, and then it must have the debit side and the credit side, because we are saying that for every debit entry there must be a credit entry. So you must have both sides of credit and debit in a journal. So this is a sample of a journal. So I want us to do an illustration of how to make entry in a journal. So we'll have this session where we have quite a number of transactions happening in January. So we are saying here that in January 2nd, you started a business with $100,000 and you paid the bank account, paid into bank account 50,000 shillings. So the first entry here will be for capital of 100,000, and then amount was paid to bank 50,000 shillings, meaning we had 50,000 shillings transferred to bank, and then we also had cash, rather a balance of cash of 50,000 shillings. So let's try to do a transaction of this, or the first transaction here. So I will take you to Excel workbook. So we're saying the date here was rather it was 2022, then it was in April, on January. Let's call it Jan. And then the first transaction happened on 2nd, and then this guy started business with 100,000 shillings. So here we are saying cash account, $100,000, rather $100,000, not 100,000 shillings, but $100,000. And again, we are saying to capital account, we have 100,000 shillings. And then when you are doing a journal, entry, you must have narration to tell what the transaction was all about. So this one was brought money to start a business. And you can see started a business with 100,000 CH, rather $100,000. I started a business with with $100,000. But the narration has to be very short, has to be precise to the point. So that was second, and then on the same transaction, he transferred some amount to bank. He transferred 50,000 to bank. So here we say bank account, $50,000. And then here we are saying to cash account. Cash account was affected by 50,000 shillings because he started the business of 100,000 shillings, and then was in cash, and then 50,000 shilling was transferred to bank, meaning cash was reduced by 50,000 shillings. So here we are saying amount transferred to bank account. So the first transaction we've done a journal for, rather we've completed the journals for the first transaction. So let's move to the second transaction. So the second transaction, we say he bought furniture in cash worth 5,000 shillings. So we will say, so this was 3rd January. Furniture, so here this one will go furniture account. So here we had 5,000, and then here we'll say we bought furniture in cash, so the cash account was affected to cash account. Then here we are saying bought furniture. So let's move to the 3rd transaction, which is 5th January. Bought goods in cash worth 30,000 shillings. Bought goods in cash worth 30,000 shillings. So I bought goods on 5th January. So here we'll say stock account. Stock account, we had 30,000 shillings. And then we bought them in cash. Now cash account was affected, so we'll say to cash. And you can say here purchase of stock in cash. Then the next transaction here, we are being told the guy sold goods for cash worth 6,000. So he sold goods in cash worth 6,000. So cash account was affected. So this is 6th January. So here we say cash account. Cash account received amount worth 6,000. And then stock account. So let's call it goods account instead of writing stock account. Let's call it goods account. So here we'll say to goods account. So sold goods in cash. And then when you are doing our journal, we must write here we'll write DR. So we must show that we are debiting that account. This one sold, so DR. And this one also as well, DR. So the next transaction we built on 10th January, bought computers worth 18,000 from ABC PLC on credit. So computers were both on credit worth 18,000 shillings. So here we have this was 10th, and then we're saying computers account. Computers account. So it was 18,000, and then it was bought on credit. So we have creditors, but now let's mention the account holder of that credit account, or the ABC PLC. ABC PLC account 18,000. So we are saying bought computers and credit. And then now let's try to close this journal. So the next journal you're saying on January 14th sold goods to C&D company worth 10,000 shillings on credit. So goods worth 10,000 shillings was sold to was sold to C&D. So here we have sales, but the sales were made to C&D. So these sales were made on credit. So we are saying, so we are having debtors account, but the data here is because we are selling on credit, C&D will pay goods after some time, but they were sold 10,000 goods for 10,000 shillings on credit. So the account here we are affecting here is the C&D account, but C&D on account is a credit, rather is a debtor, because we are selling goods on credit. So C&D account, we are saying we sold for him goods worth 10,000. So here we'll write 10,000. And then here we'll write to goods account. So you're saying for every debit entry, there must be credit entry. And then we are saying sold goods to C&D, and credit. And then on 15th January, bought goods on credit worth G&H company worth 20,000. So bought goods on credit. So the account here that was affected was for goods and was for also for creditors, and the creditor here was G&H. So here we are saying 15th January. So we close this journal. So 15th January, you bought goods account. So here we have 20,000 and to G&H, and then we're saying bought goods on credit. Bought goods on credit. So that is the narration for the goods that were bought on credit. So G&H account. So this one we must write DR. I just forgot to write DR, but here we need to write DR to show that that's the first account that the account that is being debited. And then let's now try to close the journal. And then next we are saying he paid 2,400 for mobile phone. So here we have a mobile phone expense, but it was paid in cash. So two accounts must be affected. Then mobile expense account and the cash account. So we are saying here this was on 18th. So here we are saying, so we can call this one telephone expenses. Expenses account. So here you start with 400. Then we'll set 2. cash account. Then we will narrate paid telephone expenses in cash. And this one is DR. And here we post this. Then moving forward, this guy paid 1,000 for advertisement. So we have this was paid on 22nd. So we say here 22nd advertisement expense account. Let's just call them advertisement account. ADR. They did 1,000. Then here to cash account. Then we said paid advertisement in cash. This one also we can call it telephone account, or just let's leave it telephone expense account, and then let's close this journal entry. And then again we are saying on that of August, sold goods worth 8,000 to Mrs. Johnson in cash. So received cash worth 8,000, and then the goods account also was affected by 8,000. So here we have this was 26th. So we sold goods worth 8,000 to Mrs. Johnson. So here in our knowledge account, there's no place that Mrs. Johnson will not create account of Mrs. Johnson, because we sold to Mrs. Johnson in cash. So here we'll just say account. So here we write 8,000. Then here we write to goods account. 8,000. Then we'll also close this channel. You don't need to close this channel, you not write the narration. So you have to say here sold goods in cash. So this one is DR. And again, now we need to insert models. Insert models. So this one is just a formula for debit and credit. Whatever is here, you can say is equal to J46. So for every debit 20, there must be a credit 20. So instead of just writing manually, I did a formula here. And the formula is just an equal sign that equates a debit and credit. So here we will close this channel again. And then we on 30th January. So on 30th January, we are saying paid 12,000 for salaries. So you paid 12,000 for salaries. So now we have a salaries account. Then here is DR. Here we are saying you paid 12,000, and then it was paid in cash. So cash account was affected to cash. And then here we are said paid salaries Then we close this journal entry. And again on the same 30th, we had he paid 5,000 for rent. Here we'll say rent account. Here is DR, then here we also write 5,000. We just and then to cash account because he paid in cash. Then we said paid rent. Then we close this start journal. Then lastly, you're being told they took 8,000 for private use. So when he took 5,000 for private use, we are assuming that he reduced the capital that he injected the business. So we want to affect the account for the capital and the account for cash account. So we took 5,000 from the business. So here we know we can do two journals. We can do a journal for I will affect the drawings. So drawings are those the amounts are being taken by the proprietor from the business. We call them drawings. He's taking money away from the business for personal use. So call that drawings. But still again can also affect we can also just affect the capital account, reduce capital account, and then we debit his drawings account at the personal use. So here we'll say he took cash from the business for personal use. So here we'll write this one drawings. Drawings account or capital account. Drawings account. So this one is DR. We are writing this one. It took how much? It took 8,000. And then we to because it took cash from the business. 5,000. Then we are seeing took cash for use. So instead of writing drawings here, you can just affect the capital account. So we just write here capital account reduced by 8,000. Okay. So remember we are saying debits they will increase the expense and assets account, but they will decrease the capital and liability account. Here, a case where we have capital account being debited, so it will reduce the capital account by 8,000. But instead of writing capital account, we've written drawings account. So again, you can decide to write capital account or drawings account. So here we'll write drawings account stroke capital. Make it for you to make it easy for understanding. So ladies and gentlemen, we've done all the journals for all the sections for this illustration. So I hope we understood how to do a journal, and this is what we call the journal entry before we move to ledger accounts. So this is what you're supposed to do for this is what you're supposed to do for every transaction before you move to ledger accounts. So we are saying, rather, let me just do a recap of what we talked about a ledger, or rather journal. So we are saying a journal is a detailed account that records all financial transactions of a business to be used before future reconciling of accounts and the transfer of information of other official accounting records or ledger accounts. So we've just done the recording of financial transactions to a ledger account. So this is what we call journal entry, and you see now we've done the journal entry. So lastly, here before we call it a day, so we are talking about our practical system. So when we talk about a practical system, we mean in a normal business, you'll be having a lot of transactions within a day. So the transactions will be revolving around sales, they will be about purchases, and then the cash transactions within a day. So when the bulk of when we have quite a number of transactions of sales, purchases, and then the cash transactions or bank transactions, we need to separate the journals. We need to have the different journal books for sales, and then different journal books for purchases, and then different journal books for cash. And then again, when you have returns to you've sold but customers are returning your goods, you could also have a sales return book. And then when you are purchasing and then you are returning purchases, you are returning the goods that you've purchased, you can also have a purchase returns book. So in a normal in a practical system, you'll maintain different journal books. You'll maintain a sales day book. Fine. You maintain a sales book. So this is our sales day book here, and we also call it a sales journal. And then you'll also maintain the purchases day book or purchases journal. So when you maintain a sales day book, it will only be meant for credit sales, those sales that need to be, rather you need to receive the revenue at a later date. And then when you maintain a purchase journal or a purchase day book, there will be the transactions for credit purchases. So they're the purchases that you will pay later. You're not paying them in cash, because you are paying when you are paying them in cash, you will enter the transactions in a cash book or a cash day book. And then you also have a sales return or return in notes journal. So this is just for returns. And the sales returns are quite a number, is when you'll create a sales return day book. And then we also have a purchase return or rewards journal. So this one is also meant for numerous purchases returns. And then we also have a cash book. So this one is meant for both cash and bank transactions. So when you are buying or selling and the amount involved is the cash, we use a cash book or a cash journal. So these are the day book we are calling the journal. So these are the transactions that will not take place in these other specialized journal books. So when you have other transactions that will not take place within the sales day book, purchase day book, sales return, purchase return, cash book. So these are the transactions, you'll put them in this other journal. So we are calling it the journal. So these other are just specialized day books, specialized journals for the specialized transactions. So I hope, ladies and gentlemen, you understood what we mean by practical system. So I want us to call it a day for today for this video, and we'll meet again on the next video when we are doing the cash book, and then we'll talk much more about cash book and the columns within a cash book. So thanks for watching, and let's meet again in the next video.